What is the real power of position sizing? I'm going to demonstrate that today. Hi everybody, my name is Cody Koch. Welcome to the channel where we talk about advanced trading, investing, and business concepts. Now today I'm going to film this from my computer because this is the best way to demonstrate this concept. Now what is position sizing? Position sizing is simply answering the question of how much of your portfolio or net worth you want to put to risk in any given trade or investment. Now I want to be clear about this. How much you put to risk is not the same thing as how much you put into an investment. For example, you put a $100,000 investment into, let's say, some stock on the stock exchange, but you have a stop loss in place. And let's say that stop loss is such that if the stock goes against you by too much, you automatically get out for a loss of, let's say, $5,000. So in that case, you're technically only risking, at least hopefully, ideally, $5,000. Now granted, it's perfectly possible the price will rip through your stop loss so fast that you may take a greater than $5,000 loss in this example, but your position size, in this case, you're risking $5,000, even though you may have purchased $100,000 worth of shares. So I just want to kind of clarify that. Risking is not the same thing as how much capital you put into an investment, okay, or trade. Here's how I'm going to demonstrate this. What we're going to do is we're going to take an example of 5 hypothetical traders. As you can see them, their names right here on my spreadsheet. Each trader has a different strategy for position sizing, and I will reveal to you at the end of this session what their strategies were. Some of these strategies are very smart and some of these strategies are not very smart, but all of them are very different. And so I'm going to show you through this in a very similar way a mentor taught me this many years ago. This is really the best way to demonstrate how position sizing works for investors and traders by simply taking a group of investors or traders and having them kind of comparing their results after they get the exact same trades. So here's how this works. Each one of these traders will receive the exact same trades as each other. They're all going to have the exact same entry price and the exact same exit price, and they're all going to start with the same amount of initial capital. The only difference amongst them is how much of their portfolio they're going to risk on each one of these trades. Now, to demonstrate this best, I'm going to use what's called R multiples. Now, R multiples are used as a method to separate position sizing strategies from the underlying system's performance. You can actually see a system in how it performs using R multiple distributions. I won't go into that in this video very much, other than just to say we're going to use R multiples in order to properly demonstrate this, because it's really the only way to do this. So what we're going to do, and this is how it works, we're going to have a dice roll. Okay, I'm going to have a 20-sided dice, and I have a website that we're going to use that's free online to represent this. And each one of these dice rolls will give us a different R multiple. So for example, if we roll a 20, we're going to get 10R. And what that means is if a trader risks $1 or investor, doesn't matter, trader or investor, if they risk $1 and they roll a 20, they're going to get $10 in profit. If they risk $1 and roll a 1, they're going to actually lose $5. That means it blew through their stop loss or some kind of method to protect their downside. So whatever the roll gets will provide the R multiple that's gained or lost in this case. And so through this simple little process, I'm going to be able to compare how each one of these 5 traders do, okay? And as I've already said, each one of these traders has a different methodology of, or an algorithm you can call it, of position sizing. And so we're going to see how this kind of performs. Now, I set this up so that if you are interested in playing along with this game, just to see how you kind of perform, you totally can. We're going to take it step by step, and we're going to edit this through so it goes very quickly, as fast as we can. But you're going to be able to see each trade. You're going to be able to set your next trade ahead of time before we go ahead and continue on to the next dice roll, so you can get an idea of what you could have performed. Otherwise, you can just watch the video and get an idea. I'm going to do at least 35 trades. I may do more, depending on kind of what I'm trying to demonstrate here. But in the end, I will show you exactly each one of these traders' methodologies and what they would have done and performed in real life. So here we go. Let's get started here, and we're going to start with each one of these traders already has their initial bet before the first roll comes through, and we're going to start this process now. Now I'm going to bring it up. Okay, so here's our dice. It's on freeonlinedice.com. I wanted to use this because it's a way to prove that I'm actually doing this completely randomly. I am not picking and choosing the dice rolls we get. If we have a big losing streak, naturally, we're going to have a losing streak in this video. If we have a big winning streak, we're going to have a winning streak. I'm not going to pick and choose what we do here because the results in the long run will still end up being basically the same whether we have big losing streaks or winning streaks in this game. So what I want to show you is that everything I'm doing here is truly random. I have no idea what's about to happen. So we're going to click on the first dice roll. We got it set to 20-sided dice, and our first dice roll is 4. Okay, so let's go back to our sheet. A 4 is a -1. 2 to 11 roll makes it -1. So we're going to go here, -1. Boom. All right. And you can tell in this case, because I have a spreadsheet, it's automatically calculated all of these winners and losers. We're going to go ahead and start with the next one, and we'll continue with that. If you're interested in playing along, decide how much you're going to risk on the next roll right now. Okay, next roll. 13. 13 puts us as a +1. Okay, we've updated everything here, as you can see, and now we're going to go ahead and speed this up pretty quick, and I'm going to zip through this as fast as I can. If you're interested in playing along, I would recommend pausing the video in between each dice roll, because you probably won't have enough time to do put your numbers in and calculations and everything, because we're going to make this kind of fast through the edit. Okay, next dice roll. It's a 1. Uh-oh. That is a -5, folks. That is no fun. Ouch. That really whacks everybody here pretty good. And I want everybody to notice something right now. Al already went bankrupt. His portfolio is less than 0, which means he must have been using margin or something, and he blew up his portfolio. That really stinks. Beth is down pretty significantly herself. Chloe is down, but not very much, actually. She's doing okay. You've got Dan, he's down notably as well, and then you have Eve, who's also down pretty notably. So we're going to kind of see how this goes from here. Okay, everybody, so if you're playing along, next up will be a 2, which is a -1. Starting off this game kind of rough. Okay, next dice roll. A 9. A 9 is a -1 also. So we are having a bit of a losing streak at the moment. It's not uncommon though. If you guys have taken notice on this system, the system actually wins only about 45% of the time. So take note of that. It's a very interesting fact that you can actually make money on systems that win less than 50% of the time. Okay, next dice roll. 4, another loser, -1. Next dice roll. Here we go, folks. 8, another loser. Now, you may have noticed I just basically stopped doing Al because his numbers weren't making sense anymore. He went bankrupt, he's out of the game. Okay, everybody, your risk is in. Decide how much you're going to risk on the next one. Dice roll. It's another 1, which is a -5. We're getting hit pretty hard here, folks. This is a pretty rough run. It's pretty ironic and amusing. You can see poor Beth has lost approximately $97,000 of her $100,000 portfolio. Chloe's lost about $7,000 of hers. Dan has lost over half of his, and Eve has lost almost 30% of hers. So let's just see how this keeps going. Next up, 12. So 12 is finally a winner. It's only a +1, but notice how many losers we had in a row. That was not actually a lot statistically. That's only 6 losers in a row, and there's only a 45% chance of winning. That happens probably more often than people realize. What is unusual to have 2 -5R losers. That's pretty unusual. Okay, so let's do the next roll. 12 again. That puts us at a +1. So that's 2 winners in a row. They're both 1Rs. Let's see how this plays out. Next roll. A 10. 10 is a -1. So this is our -1, brings it up here. And as of now, we have Beth has lost 96.5% of her portfolio. Chloe's lost, 6,500. Dan has lost 50,000, and Eve has lost, in this case, looks like 27,000 or so. Next roll. 6. That is a -1. Rough road here, folks. This happens sometimes in markets. I've seen this more than a few times in my day. And I promise you, this system is most certainly a positive expectancy system. So in other words, it should make money over time if our position sizing strategy allows us to survive. Next up, 9, which puts us, the 9 is again a -1. We're having a good rough time here, folks. This happens. 14, that I believe is a positive 1. Next roll. 18. Finally, we've had a bit of a winner here. This is a +5. Hit the wrong button. Okay, we have a +5. Hopefully, this will be the beginning of the end of our losing streak. We'll see what happens here. On to the next one. 3. 3 is a -1. All risks in. Next roll. 6. That's a -1. Next roll. 20. All right. Winner, winner, chicken dinner, folks. We finally got that going. Here we have it. Now, this is starting to notably turn around. That one Big 10 winner, that can make all the differences in the world when you have a system that has a really large winner. It may be uncommon. In this case, it's only 5% chance of it occurring, but it can be pretty significant. So, big winner. Let me just, now after that big winner, Chloe is almost back to break even. Beth is still down over 90%, unfortunately. Eve is down about 9%. Dan is still down about 22% or something like that. So everybody still has a ways to go, but we'll see how this plays out. Next up, 18. All right, that's another 5R winner. This game is definitely turning around very quickly. Next roll. 9, that would be a -1, I believe. Yes. 12. 12 is a +1. Next roll. A 10, which is a -1. Okay, next up. We've got an 11, which would be a -1. Next roll. 8, which is a -1. You'll notice I'm having to make some calculations, adjustments on some of the algorithms. I have to update them occasionally to make sure they're accurate. Okay, we're going to the next roll. 4, which is a -1. 18, which is a +5. Next. 13, which is a +1. 3, which is a -1. 9, which is another -1. 14, which is a +1. Next roll. 19. That is a +5. 13, which is a +1. 19 again, that gives us a +5. 8, -1. 10, -1. Next roll. 19, that's a +5. Next roll. That's a 16. That is a +5. We've had 2 +5s in a row here. Next roll. Oh, a 1. That is a big old -5. Everybody took a hit from that. Okay. Keep on going. Next up. 18, which is a +5. So we went from one extreme to the other. 2, which is a -1. Ooh, 1 again. -5. 12, which is a +1. 9, -1. Next roll. 14, which is a +1. Next roll. 8, that's a -1. 4 is a -1. 4 is another -1. 8, -1. 16, that's a +5. 13 is a +1. Next roll. 5, that's -1. Next. 16 +5. 15, I believe that's a +5. Yes, no, a 15 is a +1. 16 is a +5. 11. Next roll. 13. That is a +1. Okay, so we're almost on trade 60 here. So far, this is Beth. She is at $35,000. This is Chloe. She's at $115,500. Dan is at $255,000. And Eve is at $227,000. So we're going to go a little bit longer and see if we can see a significant difference, kind of see if these traders start to significantly expand beyond these points and see if we can have more of a dramatic effect. Next roll. This is roll for 60. Okay, we got 4 on this one, which is a -1. Here we go. This is trade 61. And we've got a 20, folks. Winner, winner, chicken dinner, as they say, and that is a +10. Wow, this is really starting to separate the traders, and you can see a significant difference between their portfolios. A 9, which is a -1. 14 is a +1. Next, 1. This is a big old -5. That always hurts everybody, just a little bit. 20, another 10. This is a big 10. This changes a lot of things for a lot of people. There we go. Let's see what happens. A 2, which is a -1. 11. 12, which is a +1. 10, which is a -1. 17, which is a +5. Everybody have your risk in. Decide how much you're going to risk. And 5, which is a -1. That is 8. Next is a 18, which is a +5. 2 is a -1. Next roll is a 14, which is a +1. 7, which is a -1. 3, which is a -1. 9, that is another -1. 19, which is a +5. Oh, it's a 20, folks. That is another 10. Winner, winner, ladies and gentlemen. There we go. This game is getting very interesting. I'm actually quite surprised by some of these numbers. It's just what happens statistically. Sometimes things just do stuff that they do. This is really crazy. So I'm going to try to get one of these traders to 1 million and see what happens, and we'll probably stop about there. So next trade is for row 81. 17, which is another 5. 12, which I believe is a +1. Let me double check that. Yes, it is. Okay, so we got a 1 on the dice. This is a -5. Big hit. Okay, so we're going to make sure we get back to 1 million. So we're definitely going to try that on this next one. See what happens. Something gives us a 5. 2, that's a -1. 14 is a +1. 2 is a -1. 13 is a +1. 8, -1. 1 is a -5. 18 is a +5. Next up, 11 is a -1. 3 is a -1. 10 is a -1. 19 is a +5. 2 is a -1. Okay, next roll. Come on, give me a... all right, there we go. 17 gives us a +5. A 5 is a -1. 9 is a -1. Next roll. 18 is a +5. I'm going to go ahead and complete it down to here. Once we get to the bottom of this section here, you will see, once we get to here, this is 100. Almost there, folks. 10 is a -1. 5 is a -1. 12 is a +1. Almost there. One more roll, everybody. We'll see what happens. It'd be fun if it was a +10. We'll see what happens. I have no idea what's about to happen. It's a 14, which is a +1. Okay. There we go. All right, so that completes 100 trades. Hopefully you guys are still with me on this. Okay, so here's how this works. Al went broke within the first 3 trades, obviously because his position size was gigantic. We'll talk about that in a second. Beth, ended up at $64,000, so she was down overall. You have Chloe, who ended up with $136,000 even. You have Dan, who ended up with almost $1 million, a little bit shy. And you, of course, have Eve, who had 922,000. So she was about 80,000 shy of 1 million. Now you can tell Dan and Eve were pretty close together most of the time. Eve was just a little bit less than him for a variety of reasons I'll explain in just a second. So this is what happened. I'm going to show you their position sizing calculations. Al did a set 25% of his portfolio with every single trade. You have Beth, she risked a steady 15%. Chloe set at $500 each. Dan set at 4.75%, which was an adjusted Kelly criterion. I won't go into that. I don't recommend Kelly for a lot of people. You got to be really careful with it. So I use an adjusted Kelly criterion. And there's a lot of more details. You got to worry about portfolio heat and correlated trades, and there's a whole bunch of stuff involved in this. I won't go into this video, but just be very careful using this number for your trading. I really don't recommend doing that. So we're not going to go into that yet, but just be very careful. But I'm just giving this as a demonstration, as an example. And then Eve used a little bit more of a sophisticated algorithm. She had a set 2% risk of if the capital was below her starting capital of 100,000, and if it was above the starting capital of 100,000, she had a set 5%. A steady 5% risk. So that's why Eve's numbers are very interesting, because during the drawdown phase, which happened completely by accident, I didn't plan this, folks, Eve didn't lose nearly as much as Dan did during this drawdown phase, as you can see here by the sheer numbers. Poor Al, his portfolio just completely collapsed here. And you can see that this was pretty rough for him. Okay, unfortunately, he only got 4 trades, so I barely need even to demonstrate that. Okay, so you can see here with Beth's chart, she basically started with 100,000 and almost immediately went near zero, spiked above 100,000, went down to zero again, spiked massively, and then crashed again. What's going on with her position sizing strategy? Well, she was using 15%, as I pointed out here. The problem with 15% is it's way too much. Math is not fair, okay? Especially in the trading investing world. A 50% loss is not the same thing as a 50% gain. Okay. And so one reason position sizing is so important and so powerful, for example, you start with $100 and you have a 50% gain, you gain $50. But if you immediately have another 50% loss, then you lose down to $75. So technically, in terms of percentages, you should be even, zero. 50% gain, 50% loss. But the way the math works, statistics work or percentages work, that actually you're down 25%. Because you gained 50 to go to 150 and then lost 50%, so you lost 75 to go back down to $75 even. So you're in that kind of tough position there. What happens is in position sizing, there's always an optimal point, the amount of risk you should take on. And if you exceed that by too much, you get this kind of chart. Your portfolio gets really crazy. And so that's why this happened to poor Beth here, was that her portfolio, her position sizing strategy was such that it was just completely losing its mind. Now let's check out Chloe. Chloe had an incredibly conservative position sizing strategy, just a set $500. Not very conservative, as you can tell here by the chart. It was a nice steady uptrend, small drawdown, wasn't too severe. I mean, we look up here, the worst she got down was she didn't even break below 90,000, so at no point she got below a 10% loss. It was a pretty small loss, and then she's had this nice steady uptrend. That's the advantage of position sizing less rather than more, as you get more of a smooth chart. Now, granted, a lot of people say, well, you left a lot of money on the table. That's true, but psychologically it's much easier to handle, and most people actually enjoy a steady uptrend far more than they enjoy really massive increases with a lot of volatility. So as you can see from Dan's chart, he's had quite a bit of volatility, but he overall has grown quite significantly. He's kind of the winner in terms of the sheer growth of the portfolio and made the most money. The problem with his portfolio is it's prone to significant drawdowns. As you can tell, it got all the way up here, then crashed down quite a bit, lost over 40% of its portfolio, and then back up. That's a pretty volatile portfolio. Most human beings can't handle that. You shouldn't have to handle it. There's a lot of sophisticated ways to minimize this dramatically and still make it significant upward profits like this. But this kind of volatility most people can't handle, and it's actually pretty tough on trading systems. And as I said earlier, math isn't fair, so to speak. Gains and losses are not the same thing, and this is one reason you get the volatility. Now, the Kelly criterion, I want to be clear about this, is the ideal, in theory, the theoretical ideal risk level for a trading system or any kind of investing trading system or gambling system or whatever you have in place. I don't recommend gambling, by the way. But the Kelly criterion is a essentially mathematical optimal range. The reason I don't recommend it for trading and investing is because you never really know the true performance of your system. And your system can change over time. It will change over time. The more profitable it is, the more it'll draw competition in. The more competition you get, the less its profitability will be. It'll go down. So the Kelly criterion is really only designed for very precise data sets that you know the precise statistics and there's no way to waver from them. The Kelly criterion only works in that case. Generally speaking, if you're risking, in fact, I would say almost always, if you're risking more than the Kelly criterion and an adjusted Kelly criterion would recommend for a trading system, you are definitely risking way too much, okay? But I won't go into more details in that other than to say you've got to be very careful with it. Next, let's try Eve's and see how she did. Okay, her chart looks very similar to Dan's because they were using a similar algorithm, except for the fact that Eve's drawdown initially was significantly less than Dan. And the reason it was because she was risking significantly less than Dan was during this drawdown phase. Of all the position sizing systems I have among these 5 traders here, Eve's position sizing strategy is by far my favorite. And the reason is because it allows for these very small drawdowns. As you can see, while Dan was hitting 45,000 on his account, she hit only 70,000. So she was significantly higher. And that means for me that if a system stops working, you're going to see this in Eve's case far in advance before it really eats up most of her profits, whereas Dan will lose most of his profit before he realizes his system isn't working anymore, there's something wrong. That is one major reason I prefer Eve's system. It's nicely profitable, can be significant, but it definitely is able to protect the downside, which is by far the most important part. Now overall, there's so much more to talk about this, and I could talk about this for hours. I do want to point out a few other things. The position sizing I'm showing you here is very uncorrelated. Every trade has been perfectly uncorrelated to the previous trade, which is, in the markets, the only time you get that is if you enter a trade and then at some point close it out and then don't enter a second trade until you close out the last trade. What often happens is most traders will enter 10 trades simultaneously, 5 or 10 or 20 trades simultaneously. Well, the way markets work, especially if they're part of the same system, those 10 or 20 trades that you have on simultaneously will all be highly correlated. They'll move together. So let's say you're risking 1% on each one of your positions and you have 20 positions on. Well, technically, that's equivalent to risking 20% of your portfolio. That's massive risk, and you can accidentally, essentially over-position size your trading system or investing system. And so that's a kind of a word of warning. Be very careful with this. There's a lot of different layers to this. It takes time and a lot of study to really understand all the different aspects to it. Also, you can have a lot of trades on simultaneously if they're all highly uncorrelated with each other, preferably perfectly uncorrelated, in which case you can actually put a lot of trades on at the same time because it means that they will all cover each other. Some will lose, some will gain, and it'll end up roughly balancing out. And that's assuming your system is perfectly uncorrelated, which unfortunately it may be a lot of the time, but occasionally your system, everything will become correlated because you have some kind of market upheaval, or the world blows up, a city blows up in the world, who knows what's going to happen. You will start to see a significant correlation when otherwise all your trades may have never been correlated before. So be wary of that. So I want to reiterate one more thing is you can just see the massive difference between these 5 traders. Huge outcomes. They all had the exact same buy price, the exact same sell price, and all 5 of them had completely different outcomes. I do want to point out one thing, and this is really important, and I'm going to throw up some statistics for you. So you can start with 100 traders or investors. They all get the same buy prices, the same sell prices, and all start with the same amount of capital. What you will find, and I learned this from one of my mentors, out of those 100, 30 to 50 of them will lose their entire portfolio. A further 20 or 30 or so, give or take, and I'm not giving you exact 100% round number, will be similar to Beth here. Well, they'll have a system that may be profitable, but the portfolio is so volatile or even steadily declines because the risk is just too high. You'll also have another 20 or 30 that'll be much more like Chloe. They'll have this nice steady uptrend, and I realize I'm close to 90% at this point between these 3 numbers. And then you have somewhere between 2 to 5% of traders. I realize this isn't adding up to exactly 100, will be like Eve. Okay, so only 2 to 5 of traders will end up like Eve or Dan, where they are significantly profitable and they made a lot of money. The problem is that only 1 of those 2 to 5 actually really understands what they're doing with position sizing. So in other words, that means most of those 2 to 5 got lucky. In other words, they position sized right, and they may have not known that they did it. They may not understand how they did it. They just did it correctly, and they will not be able to repeat it consistently because they don't actually understand the true philosophies and the math and the statistics behind what they did. To my amazement, I learned from my trading coach that out of 100 traders and investors, only about 20 actually have a system to guide their actions. And out of those same 100, one, actually less than one, fully understands the sheer power of position sizing. Okay, so that's it. That's what I wanted to show you guys. This is the power of position sizing. This is what it can do. I really recommend you guys pay attention to it. It's one of the biggest secrets to the markets, and you're going to find it's very rarely understood, very rarely studied by very few people. And so it's the best of the best, though, in the markets pretty much understand this. Either intuitively or they understand it through sheer math and statistics. And this is why you will see some of the most successful hedge funds and investors and traders in the world talk about this subject greatly. All right, this is what I have for everybody today. Hopefully you guys found this interesting and useful. If you did, please like this video, subscribe to the channel, leave a comment. If you have any questions, please leave a comment in the comment section and I will try to answer that in some future video or some such. I appreciate everybody watching this far and have a great day.